Welcome, everyone, to today's Fintech Hot Seat Head-to-Head. My name is Craig Jeffrey, and I'm the founder and managing partner of Strategic Treasure. Our topic for today is cash forecast, and we're pleased you could join us as we consider the challenges and relevant solutions in this space. Let's cover our format. Each company has 11 minutes total time to present. There's 8 minutes for them to present, followed by 3 minutes of question and answer. And for the audience, if you'd like to ask a question to a particular presenter or about the topic in general, please put your questions in the chat box, and I'll try to get to as many of them as we can. Our participants today are from GTreasury, Mark McCormick, from Treasury 4, Mitch Thomas and Ty Heim, and from Kyriba, Tom Gavigan. Thanks each of you for participating. These fintechs have a lot to present in a short period of time. We've got a lot to cover, and we're looking forward to it. So what are the challenges in the area of cash forecasting? I think everyone should know that cash forecasting is identified by the majority. The largest percentage of companies identify cash forecasting as a top challenge, a top issue, something they would spend more money on. They would spend more time on it if they had. And at various times in the economic cycle, it becomes increasingly important. During COVID, during times of turmoil, it never falls out of the top 1 or 2 positions. It's always important. So we're looking forward to this topic. So what are the challenges that people see in that context? You can see on your screen 6 items shown up. There are more. You may have more in your company, and not everyone may be important for your organization. But the first one listed is data accuracy and integration across systems. Forecasting is born of data. It's an art and a science. Data can be in different formats in different locations. That needs to be pulled together and used. Information on forecasts may sit in accounting systems, treasury systems, various admin systems, and they can have lots of different structures. That needs to be managed and pulled in for accurate forecasts over time. If we look at data inconsistency, how does your solution handle inconsistent or incomplete financial data from various sources, such as bank feeds or ERP systems? And what strategies can be used to ensure that that data is both accurate and aligned across these different systems? If we look at siloed systems as an example, data comes from many locations. How does your platform integrate with other treasury and financial systems to break down those silos and provide a comprehensive, a fully encompassing view of the cash position, the 0-day forecast, as well as the more extended forecast, maybe out a month, 3 months, or up to a year? And can your solution consolidate data from multiple regions, currencies, and bank accounts seamlessly? And how can it gather data in when different connectivity capabilities exist? They might be file-based or newer API-based information in a more streaming environment. Most organizations are in a hybrid view. So what's happening to a lack of visibility across regions and currencies? The Pareto principle, the 80-20 principle, has limitations. We need all of the cash, not just 80%. Certainly need more than 80%. So how do you enable treasurers to gain real-time visibility across a global network of accounts, currencies, regions, and banks? And what challenges do you face in providing multi-currency and cross-border forecasting? And how do you address them, with or without pooling? I'll cover a few more topics. So fluctuating cash flows and economic uncertainty. How do you address the volatility of cash flows in changing economic conditions or for your models? How can users update their models to become more accurate over time? And what role does AI and machine learning play in predicting future cash needs in times of economic uncertainty? Where is it a strength, and where are other models more appropriate? Real-time insights and forecast accuracy. Late information is far less valuable than current information, and accurate information is better than inaccurate data. We understand those as maximums. So how do you leverage, and can you leverage real-time data and advanced technologies such as AI and machine learning to improve the forecasting? Variance analysis also provides a feedback loop. And in what ways can your system provide this corrective feedback loop into the system, either directly or via the operators, the users of the system? And smarter data and smarter data-driven decisions and liquidity optimization matters significantly. So how does your platform enable treasury teams to make more informed, data-driven decisions with their cash? And can your solution help optimize both liquidity management and working capital, the cash conversion cycle elements? And how can you help companies mitigate financial risk through improved forecasts? And then finally, the question about, is forecasting art or a science or some combination? How does your system support more and better analysis? And can your solution leverage different types of science in building and improving the forecasts? And if there are competing options or models, can your system help to test, demonstrate which models are superior, which model is superior? That's a lot of information. There's a lot of challenges. Each of the fintech companies is going to present how they might address some of these. I doubt anyone can cover all of those in the time period we have, but they'll hit some of the thorny issues. But we'll begin next with our first and only poll question for the audience before we start. And we'll pop that up on the screen. So it's a single choice. What is the most significant challenge you experience with regards to cash forecasting? Please select one of them, hit submit, and then we'll move on. Right. Excellent. The top issues, just so everybody has a quick look: gathering adequate data. And number 2, looks to be inaccurate or inconsistent data. So the top 2 are sisters for those items, and then there's quite a few other options that show on the screen. We'll share those after the hot seat as well within several days. Thanks everyone for taking that poll question. I'd like to introduce Mark McCormick from GTreasury, give you a chance to introduce your company and start the show. So you may begin.
All right, thanks, Craig. Hi, everyone. So yeah, Mark McCormick here from GTreasury. So I'm going to walk you through kind of liquidity planning, cash forecasting solutions today. So look, let's get started. Oh, okay. So what makes forecasting so difficult? So look, without a forecasting tool, this process will be managed in complex spreadsheet-based models. You'll all be familiar with the challenges this brings. Craig mentioned them. I won't labor the point, but call out a couple: time wasted on basic data capture, prone to human error, limited visibility from a basic reporting output. For those of you using legacy TMS forecasting tools, invariably you will still be leveraging spreadsheets. Okay, why? Most TMS providers, focus on forecasting at the account level, which is good for short-term liquidity management, but don't cater for forecasting at the business unit level, which is critical to.
Just a quick question. Could you turn your camera on? It's not showing you yet. We'd like to spotlight you if we could.
We can't do yet.
No.
Sorry there.
Oh, you're good.
Okay, so critical to mirror sort of business operations to promote sort of strategic decision making. So I jump into the next slide here. Sorry, for some reason that's pausing. Okay, so here at GTreasury, look, we do both, but it's important to sort of distinguish between the two. So look, liquidity planning, driven off bank accounts, takes a much shorter term view. Important in assessing, counterparty risk, whether you have enough cash in the short term to do what you need to do. Cash forecasting, on the other hand, looks at a more medium-term horizon. So, tracking revenue, expenses, profit, etc., at a business unit level, enables CFOs to, really gauge a company's financial health and off the back of that, make medium-term cash management plans. So whether that's mobilizing surplus cash, debt reduction, cash investing, capex, whatever it might be, but in effect, it's driving more strategic decision making. So look, liquidity planning then, look, this is a screenshot of our cash visibility solution. It's tracking all things liquidity and it's fundamental really for businesses with active liquidity management. So 3 main takeaways here. Allows you to easily identify counterparty exposure so that you can make quick decisions to reduce vulnerabilities. I only have to mention, say, Silicon Valley Bank or Credit Suisse. You get the idea. There's inbuilt scenario analysis as well, which means you can model out, best and worst case, outcomes, stress test, liquidity risks, proactively manage those, as well as then sort of promoting more informed short-term, investment decisions. So, i.e., what cash is available to invest in money market funds or short-term debt instruments. So if I 2 seconds there. Okay, so cash forecasting then, guys. Look, typically this will involve sort of multi-business unit complexity. Okay, local finance teams, controllers feeding into the process. So look, we have customizable, flexible org charts, okay, to capture the sort of specifics of your reporting structure to ensure cash rolls up correctly, but also that we're giving you that drill down to the underlying cash flows. So putting in place a sort of centrally controlled, managed forecasting model that connects all stakeholders, okay, to instill a better cash culture, but also giving you better sync up, better collaboration between the local teams. So the screenshot, the bottom screenshot that I have here is really of a single forecast at a business unit level. It's where we're doing the forecasting. You're looking at this, it kind of resembles Excel. That's very much by design, in terms of, look, it's very easy to use. It's easy to input data, make adjustments, add comments, etc. You'll notice this sort of forecasting toolkit that we have here. So that's available to the end user in order to sort of streamline their process, drive more automation. So if I call out a couple of these, you'll see their trend forecasting. And this is where you can start to apply various different sort of trend models, okay, to account for, seasonality, volatility in your cash flows, as well as budget modeling, which allows you to translate a more income type view into a cash flow forecast. And we also have recurring payments that can be embedded into your process as well. So look, really the key point here is that we are doing the actual forecasting in the system. Okay, it's not just a data aggregation exercise. Okay, so look, this slide, I'm not going to spend a great deal of time on this. Look, we all know, establishing connectivity with key sources of data, having that flowing into the application is front and center for everyone. What I will say is that connectivity is not a barrier for us. Okay, via Clear Connect, that's our method for sort of connecting with banks and ERPs. Any API-based bank, okay, will be up and running in 7 days. And look, the key message that I want to convey here today is that we connect all disparate, pieces of data and people in an organization, through a single cohesive reporting model. Okay, that's going to add value to all stakeholders. And look, it's illustrated here by the inputs and the outputs graphic that you can see here. Okay. So look, cash forecasting, I mean, if we break this down a little bit, like variance and accuracy analysis is often the missing link in an Excel-based, forecasting process. You have to ask yourself the question, how can you trust the output if you can't test its accuracy and ultimately quality? So, well, what does this mean really in the real world, right? Well, it's going to lead to sort of hesitancy, and a reluctance to make those sort of strategic decisions that business needs to make. Look, this is an area that we go deep on. We've got a very detailed suite of accuracy reports and also sort of best practices. So I walk you through a couple of these. Number one, look, you can easily identify which business units are performing or not. Do you have people problems? The byproduct of this is that it will encourage business unit accountability. What will that then lead to? It will lead to an uptick in terms of the sort of forecast, in terms of the quality of the forecast being produced. We can also then start to facilitate quick answers to questions, with an immediate feedback loop. So any commentary that's left within the forecast input sheet is going to flow directly into the reports. You can also add comments at the reporting end state as well. And look, we can also get super granular, and dig into the variances, at a line item, at a business unit level, and even a customer level of detail. Okay, so allowing you really to see the root causes of why variances are starting to build up in your model. And look, I suppose remember that in Excel, the lack of version control and sort of flat consolidated outputs means it's very hard to get a true sense of how your forecast is changing over time. Okay, so one of the main challenges that we see when it comes to forecasting is a poor understanding of customer payment behavior. Okay, that can lead to inaccurate forecasts, cash flow efficiencies and lost income. So we all know the due date, on an invoice is not an accurate reflection of when we'll be paid. So, what we're doing is we're tracking customer, historic payment behavior and then unlocking intelligence around, days to pay. Forecasts are then adjusted based off that learned behavior to give you a much more accurate picture of what's actually happening. So the data set that we're using there, it's AR and AP data. We can also start using that to have these sort of performance dashboards as well that will allow you to pinpoint, exactly where cash and income is being lost across AR and AP. And really, the goal with them is about providing the visibility over working capital drivers, such as adherence to payment terms, aging, overdue, really to facilitate the sort of continuous cash working capital improvements. Another thing to mention with the dashboards is that you can view them on a consolidated level, okay, but you can also drill into the actual individual customer vendor side of it, and then even at that transactional and invoice level of detail as well.
Excellent. Thanks, Mark. We're into
Right.
the Q&A. We're into the Q&A time slot. So yeah, it's okay. There's just a lot to cover. So the first question is about data governance to the particular business unit area. So if you're pulling information in, any thoughts or comments about how you help with data governance or just support what's going on?
In terms of, sorry, Craig, in terms of,
Uh, if you're pulling information from a business unit into their detailed forecast, how
yeah,
is that how do you support governance? Because that quality can be different.
yeah. Well, look. I mean, access. Within the solution, access is granted to the person that has responsibility for that business unit. Okay, so it'll only be that particular person that will be doing the forecasting, say, for whatever business unit it is. In terms of sort of governance as well, that we've a full audit trail within the system as well, so you can see who's gone in there, who's made changes, what have they done, and what time any changes were made.
Yeah, question on income versus balance sheet. The FP&A view on the income side versus treasury on the cash side. Is that a do you how do organizations support that different view and maybe alleviate some of the conflicts that come up with income versus balance sheet?
Yeah, look, well, I think, it's important probably to call out, right? They're two fundamentally different things. It's a direct cash flow forecast. So, what we are doing is plugging the short to medium term visibility gap, with the detailed kind of bottom up forecast that's typically not covered by, FP&A, CPA type tools. That type of forecasting is very much indirect. And so, like you say, you know, balance sheet, income statement, very much a longer term sort of planning. But what I would say is that once you really embed an accurate, direct bottoms up forecast, that can only be positive for, say, an FP&A team that are feeding into the process as well.
Excellent. And I guess the other thing too is on multiple scenarios, do you support back testing? Like if you're testing historical information, we saw some of the
Yeah.
comparisons. What can you say about that?
Yeah, and look, obviously, if it was a demo, I'd be able to sort of show you that, but yeah, definitely do. So we've got a range of accuracy reports. Okay, so comparison report, which is more a one-to-one, 1v1 relationship, but also then a performance report, which is allowing you to perform forecast versus actuals across multiple submissions. So really, you can get a very sort of a very wide-ranging view of how your forecast is changing over time, how it's trending into certain reporting dates, quarter end, etc.
Yeah. If you could drop your presentation so it's off screen, you can come on full screen. That'd be good. And
Sorry about
I have added a little more time just because of the back and forth there, and I'll do that on the others. In the current week, can you see week to date actuals versus forecast? That comes in from Mary.
that. Yes, we certainly can. Yes. And again, it's going to depend on the cadence of your model, whether it's daily, weekly, monthly, but lots of flexibility within the platform for sure.
Excellent. Thank you so much, Mark. Really appreciate it. Uh, thank you for sharing, for demonstrating that, and we'll begin the next section. So Mitch and Ty, if you could pull up your screen and be ready, that would be great. I'm going to reset the timer. All right, you can see the timer, and we can see you on the screen. It's clear. You may begin. Thank you.
All right, I just wanted to start off saying thanks to Brian, Craig, and the Strategic Treasury team for inviting us to the panel. A little about Treasury 4 in general. It's a modern treasury platform founded by former practitioners, so people that have been sitting in your seats in the past and have gone through similar challenges when it comes to forecasting and other challenges across Treasury. A little intro of the folks that will be speaking on behalf of Treasury for today. Myself, Mitch Thomas, I lead solutions engineering. My background is Treasury consulting and Fintech for my entire career. I'm excited to be joined by Ty, who's one of our business intelligence experts. I'll let her briefly introduce herself too.
Good morning. I'm Ty Heim. I have a background in applied mathematics and computer science. I have the super fun job of designing, creating, and maintaining all of our forecasting models. And I also get to work in our reporting platform.
All right, thanks, Ty. So jumping into kind of the reason behind Treasury 4. So I mentioned being founded by former practitioners, so people that had recognized shortcomings in legacy solutions in the past. They've used a number of legacy players and in a lot of cases just ended up extracting information to Excel, even using those, as was mentioned before, as really an aggregation of data and not necessarily a forecasting tool. And I think Craig gave a really good overview of some of the challenges and obstacles when it comes to really doing an effective forecast. And not having time to really jump into all of those, we really picked a handful of those where we thought Treasury 4 really brings value in those areas to your organizations to be able to solve those problems. And I think it starts with a system that's built to be scalable. So it's a scalable platform that when you think about time to value, we're typically seeing customers live using the system in a matter of weeks and not months. And that translates not just to getting the system onboarded, but when you think about how your organization changes, whether that be by acquisition, organic growth, or in other ways, the system is very flexible to where it doesn't require additional projects and IT to be able to address those new needs that come when it comes to the forecasting. And kind of leading into that is we have a very modern data warehouse approach where we've got an open data architecture, which is critical when it comes to forecasting data. So sharing data bidirectionally across systems, whether that be finance systems that are used for various purposes by your finance org that you need to aggregate within the forecast, or whether that's internal data warehouses. So there's no restrictions as far as the centralized data. It's a single tenant database. So it's solely for the client that is using it. There's no commingled data when it comes to the database. And we see that provides a lot of value when it comes to the forecasting tool in general. Another key piece of the forecast, we see a lot of legacy solutions that when it comes to the categorization of the cash flows that are really the foundation for a forecast, being really a one-to-one assignment where you've got a cash flow coming in that's assigned as either accounts payable or bank fees or accounts receivable. But what we use is a multi-level hierarchy of cash flow categorization that really allow you to forecast at various levels within different parts of the organization. So, and that really feeds in very nicely when we think about how our predictive analytics run on those forecasts, because having that granularity gives us a lot of flexibility when it comes to how we can apply those learning models to the actuals that we've got in the system to be more accurate when it comes to future predictions. And I'll hand it over to Ty to talk about the last item here, which is our AI.
So, like Mitch said, we are forecasting on several different granular levels. So customers are able to forecast by those transaction categories, by entity, by region, by currency, or all of the above at once. We have opted for multiple different forecasting models and allow our customers to mix and match algorithms for specific transaction categories, entities, currencies, that kind of thing. We offer traditional statistical models as well as machine learning AI models. Customers can then compare and contrast the different forecasts and choose which will be used for each and every category. Our machine learning models are done completely within Treasury 4, so all customer data is staying secure. Each and every customer gets their own set of unique machine learning models trained only on their data. Since we created these models, there is absolutely no black box here. We have full visibility into how these models are learning and why they make the decisions that they do. We also are sharing that visibility with customers to make sure they know that they can trust the results. Our in-house machine learning also means that we get to teach the models about treasury data in general to make sure that they're on the lookout for things like seasonality, transaction frequency, and anomalies. Customers have the ability to mark anomalies like one-time transactions from being used in training their models at any point, ensuring that forecasts aren't going to be skewed by large one-time transactions. Additionally, customers can add categories, recategorize transaction, or change up the rules of categorization at any time. The results of these models are then available in reporting at an aggregated high level with the ability to drill down to very granular levels. They are able to configure the algorithms, filter the results, download the underlying data, change up the visuals, and share those results either in-app or through scheduled emails. They can also set alerts to get notified of any forecasted spikes or any negative upcoming balances. And I'm going to pass it back to Mitch to show what our forecast looks like.
Yeah, and I think you're seeing, thanks Ty, you're seeing a very common theme across all of the messaging here. So the open data architecture enables a lot of flexibility across the transaction categorization, the application of the AI to the solution. And we really wanted to give you a taste of what that solution looks like in action. So what we'll actually see here is how you're getting clear visibility into the historic actuals that are leveraged for those prospective forecast items. So it's, as Ty mentioned, not a black box. You get full detail into what was used by the machine learning algorithm to predict out those future cash flows. And if we look at the video here, it's very flexible when it comes to how you're able to actually navigate around. So you see the user coming in, toggling over each of the types of transactions, and then being able to get a little more precise visibility by suppressing that history that they just used to validate the prospective forecast, and then even being able to select specific items within the forecast. So if you're really just looking to see how your cash flow matching is looking, selecting your accounts receivables to see what that near-term forecast of receivables looks like, and then matching that up against the accounts payables to kind of see where you're looking at from not just now, but in the future in a liquidity perspective. And then I'll hand it over to Ty real quick to jump through how our machine learning model works from an application perspective.
Yeah, just in terms of just real quick as we move into the Q&A, but I will add a minute as I had promised for that. So maybe you might be able to show that in the question, because the first question is on the use of AI for, you mentioned you can see the results. It's not a black box, but can you also see the assumptions and compare those models?
Yeah, so with our open data architecture, we're surfacing all that metadata about the modeling. So you get to see any assumptions that the machine learning model made about transaction frequency or seasonality or anomaly detection.
Can there, a question came, can you input other metrics or other data to train the machine learning models, or is it only limited to transaction data from banks or from input areas?
Yeah, so the machine learning model itself is based off of the historic data from the banks, but the attributes associated with those can actually inherit further granularity from other items from other areas of the business. So kind of key, an easy one to kind of show is like a CTX file, and ACH can have multiple child items within that message, and each one of those can be categorized, and that granular categorization of each individual CTX item is inherited by the actual from the bank. So you've got an additional layer of granularity there when it comes to what data is really available to the machine learning model. So it's sourced from the bank, but that bank item can ultimately inherit multiple attributes from other areas as well.
Great. If you want to pull down if you want to stop sharing, we can just be on full screen, which would be great. Another question on the AI side is you mentioned you can use those models to forecast individual components or at a group. How does how do you help companies decide we're going to forecast everything at a detail level or at a macro level? How much time does that take, I guess?
Yeah,
Go
go
ahead.
for it. So we're always going to be forecasting at as granular level as we can, and then aggregating those forecasts up to a higher level. So we're always going to go as far into the system as we can to get really good detailed forecasts that are then rolled up to those higher levels. And so with our reporting platform, you can dig in as far down as you want to go.
Okay. Another question on the data warehouse. You talked about it being an open data warehouse. It's only the company who's using it would have access to that data. Where is the advantage to that, having that an open data warehouse that can link to others? Maybe an example would provide additional color.
Yeah, you think about integration to like standard ERP systems and things like that. Those are structured data that are, repeatable across clients that are commonly integrated into forecasts. But then you have other instances where companies have homegrown finance systems and other data structures that need to be brought into the forecast. And that's where a lot of legacy solutions have challenges because they're accustomed to those normal structures, whether it be a NetSuite, an SAP, an Oracle, but those other types of data that are stored in different places, whether it be a local Snowflake instance or a different database internally, but being able to bring that data in a very streamlined way is really where that data warehouse becomes really valuable for our clients.
Excellent. Well done. Thanks for the demo, the description. So appreciate it, Treasury 4, Mitch and Ty. Thank you so much. All
Thanks,
right.
Greg.
All right. So I'm going to stop the and reset the timer. And if you, Tom, if you go ahead and come on screen, I will go ahead and reset the timer. I'll add a minute for the Q&A section at the end, Tom, just like I did for the others. So once it hits 3 minutes, we'll go to Q&A, and then I'll add a minute as we're talking. You may begin.
Thanks, Craig. Thanks everybody for attending. Thanks to our peers as well for their presentations. I'm Tom Gavigan. I lead our global pre-sales team here at Kyriba. I've been with our organization for 11 years, so I've been a part of a lot of the journey of our technology and our customer journey as well. When it comes to forecasting and the topic of today, I think we hit an inflection point specifically in terms of advancing the technology around the start of the pandemic. I think at that time there was this demand and call from the market about this need that was out there to kind of figure out what was going on, and that was an opportunity for us to really expose and understand where we were deficient, where we needed to invest, and what do we need to enhance in our product in order to meet the needs of what was being required in the market. And Kyriba was in a unique position to kind of offer that at the time, which I'll showcase here. When we boiled down to the main challenges in terms of the forecasting, doubling back on what Craig had already shared, when we talked to our customer base, we were able to kind of dig in on certain things that were of limitation that we needed to address. First of all is the silo and segregation of data that was required in order to perform the proper forecasting. In that time as well, scenario planning, being able to adjust things based on various factors that are occurring at a macroeconomic level, as well as at an individual organizational level. And then further, it was just the usability. The reality of the situation is 9 out of 10 of the people we talked to were doing their forecasting on Excel, and that was the expectation they were looking for within a solution to provide that level of flexibility and customization that they were accustomed to in their Excel models. Within Kyriba, one of the key things to this that we offer in terms of enhancing it is the ecosystem, is the data, is the centralization of the various components of the information that are out there to construct and do the proper planning. To level set in terms of the application itself and where we see ourselves in a differentiation compared as a point of differentiation is the ability to interact with multiple sets of data being inside of one singular application. The technology itself, that our planning and forecasting technology, it's sitting within the broader ecosystem of our application, covering treasury capabilities, payments, risk management, working capital. All of those other components that we talk about in payments, in risk management, and also specifically in working capital are impacting what we're doing and what we're able to offer and produce through the use of the liquidity planning. Having this inside of one single data structure allows us not only to better centralize the information that we need in order to do the planning, but also take action, which I'll talk about here in a moment. Unique in terms of what we're able to do is, and why the application in its entirety and specifically for forecasting is the necessary component of connectivity, which we just talked about. Having an open ecosystem whereby and a managed service to make sure we have the integration of necessary information that we can build and construct our plans is really integrally important to the offering of the application itself. You have one end of the connectivity spectrum, which is the banks, the ability to take in the necessary information we have day in and day out that we're using for our daily treasury processes. But having that in one place gives us the opportunity to leverage that for the points of artificial intelligence and tracking historical modeling against that information, but also importantly, to track the accuracy of it over time in terms of how our plans are evolving, where the accuracy is, and how do we refine what we're doing ultimately. The other end of the connectivity spectrum is also on the third-party application level, being able to take in the information we need from various data sources, whether it's ERPs, budget and planning tools, even Excel. We have to have the ability to quickly and seamlessly bring that in a limited IT footprint. And our open API architecture, and most recently our deployment of what we call App Studio, gives end users the ability to tap into the APIs they need, self-service, and build those or connect the data points directly. When I go in here and talk a little bit more about the application here in a second, again, what we're seeing here is a single application experience, one product, which includes the connectivity, which again is important for the overall planning, but the information being shared across the application as payments are being made, the integration automatically into the overall plans that we're working off of, as we're managing our capital structures, our debts and our credits, our investment programs, our hedging programs. Those things all also impact in terms of overall cash flow. We don't need to move data from point A to point B as we're structuring a new piece of debt, or as we're executing our FX hedging program and possibly hedging 1,000 different transactions. Each of those cash flows are going to directly integrate into your overall plan itself. And obviously, it's giving a singular experience, a singular support model as well. Before I dig in a little bit further, as I look at it and as I try to explain it, you have insights versus actionability, showing, I think many of us on the call will remember the days of MapQuest, where we would go and we would say, I need to go from point A to point B, and we would get the information we need. We print it out, we get in our car, and off we go. And perhaps it worked. Some days we'd hit construction, we'd hit an accident, and we had to make the decision of how to circumvent it. Now, as we look at modern ways in which we are able to navigate, we look at ways. It gives us actionability. It, of course, corrects and adjusts based on what's going on in the world ahead of us. And with Kyriba, we have the offering to provide that actionability, to be able to anticipate scenario plan of what is actually coming and then actually take action, deploying cash into a working capital program, accelerating receivables, for example, or delaying payables through a reverse factoring program, perhaps. We're able to do that in one single place. To bring it to life real quick, just to kind of highlight some of the capabilities therein, what I'll do is I'll quickly just transition here and just showcase it's this in the user experience and what our customers ultimately are seeing and doing. Our liquidity planning provides controlled workflow. I saw a question earlier about data controls and workflow and approvals, and this is going to show where I have the ability to kind of see and control the various business units or companies or individuals that are contributing to our overall forecast. We're able to apply a multi-level approval process and validation such that I can track who has submitted, who's reviewed, and where we're in progress. We have the ability also to have multiple plans in place, executing across those and building upon them as things ultimately change. As we go into the planning itself, we're going to have the ability to create these in alignment with what the customer is ultimately looking to do, providing that Excel-like experience. What we call structure is the way in which we can align our platform to the expected output and control that customers are natively doing in Excel or in other applications. This allows me to see the information I need to see over my plan, whether it's short-term or long-term, with the ability as well that I can go ahead and look at this at a monthly level. I can look at this daily, weekly, quarterly, or whatever level of granularity in which I need to see it. We have the ability as well, in which you see here, is to control the data sources. We understand that when it comes to planning, information comes in from different areas of the operation. From the ERP, we have the ability to connect directly to that ERP and call in an API. And I can then go ahead and load all of these at once, or I can individually structure and recreate my plan by saying, go out and pull out the AP invoice activity, and it'll recalculate and pull in the necessary information accordingly. I also have the ability and the granularity to drill down into what is actually composing that information at an invoice level. I can look at referential information and data that composes that information day in and day out. Lastly, as well, what you also have is the historical modeling and artificial intelligence that we can apply against that as well. Self-controlled and contained, you have the ability to define what those are going to be. Using your historical information, we can see what it's trending off of with the ability to control how it's being calculated over which time horizon and adjustments, and compare the AI model against perhaps what already is being integrated from elsewhere.
Excellent. Thanks, Tom. Exactly on time. A couple questions. Looking in the chat box as well. First is you mentioned integration with budget and planning systems. Those tend to be income oriented. Treasury tends to be cash oriented. How do you manage the issues of conflict or where there might be a prioritization?
Yeah, so we have the ability to kind of structure the different plans in the application, and then using variance tracking, be able to kind of bring the gap between the two, between the direct and the indirect model. One of the things we're doing as well as we look into the future here, and it's been well communicated in various forums, this is an area where modeling will come into our platform, whereby we'll be able to apply more of those data sources, which I was talking about, applying actual more formulaic controls to take in financials and extrapolate cash flow off of that as well. We have ways in which we do it, but we'll actually be more tightly integrated at the FP&A level within our liquidity modeling offering.
Thanks. You mentioned actionability, making adjustments. You gave one example. Can you give another example of how the system can automatically make adjustments?
Yeah, so one of the things I wasn't able to show is, within the scenario ability to be able to identify and see where you're at in relation to a free cash flow target, for example, where you're where you're deficient, where you have excess liquidity, you can kind of take the information and see it. But one of the things what we are able to do and what we see our customers doing now is taking that information, since we're collecting information at an invoice level for say managing working capital programs. We and our application can then say, hey, take these invoices that we have, say our receivables. We can then in our application take the portfolio, approve them, and push them off to our factoring or push them off to our pool financing or securitized structures that we have in place with banks. Our application is built such that we are managing the overall, say, receivables financing program, and that's a difference. It's the same invoice that you're looking at within your plan that you're also then saying, hey, sell that off to the bank, and I'm going to collect the cash more quickly, and then I'm going to come in alignment with our cash flow target.
So is the outside capital, is that linked to the Kyriba's supply chain financing option or factoring or others as well?
Yeah, it's agnostic. That's correct, and this is an area where we're really kind of seeing more excitement and more appetite, I would say, in the market.
Okay, so regarding multiple plans, Tom, where you can have multiple models, plans, scenarios being run. How do you support things like back testing or comparing models as you're looking to make a change in a model?
Yeah, so that goes also to the variance tracking, which we weren't able to kind of dive into. But with what you saw is the ability to kind of maintain multiple versions of the plans themselves, and then each version of a plan also has the ability to have an endless amount of scenarios applied against that plan, allowing you to say, okay, we're going to make a international acquisition. So take our current plan, but also factor in perhaps this other CapEx that we're going to incur. And then you can use and run those simultaneously. Within the variance tracking, what you have the ability to do is to look at a side-by-side comparison showing scenario A versus scenario B, as well as also then importantly as well, which I started out on, incorporating in the bank actual. Where did we actually land in terms of what actually occurred? And then that helps us then refine the overall forecast process itself. So the variance is going to showcase where things have trended over time. There is also on the AI side of things, which we again saw very high level, there's back testing there that you can go in and validate against the models that we have that are being used in the calculation.
In 10 seconds, when you're showing data coming from other sources that might be late or contain errors, how do you exclude that?
Sorry, what errors there, Craig?
If there's errors coming from a particular area that you know that there's something wrong, how do you exclude that?
Yeah, so there's integrity checks that are going to occur on the data flows coming into the system. So there isn't, you have transparency when there are sort of, again, issues with integrity. Integrity could be misalignment of data, but also duplication of data. So you're going to have those things stopped, and you have the ability to review and action if you want to exclude or include. But you're going to get kind of audits in terms of all the integration points. Your payables coming in this way, other information coming in a different way.
Excellent. Thank you so much. I'm going to stop
Thanks,
the
Greg.
timer. Appreciate it, everybody, for each of your presentations. So thank you to GTreasury, Treasury 4, and Kyriba. A couple summary points. We saw at the beginning some of the challenges for Treasury and forecast being time requirements, the ability to be flexible and scalable, to leverage technology to allow for more forecasting to be done. The question of accuracy and variance was presented in several different ways. We saw multiple models being run and supported, different ways of handling data. We saw visibility and flexibility of models shown. We got to taste a little bit of artificial intelligence and machine learning to help address areas of modeling and having visibility to those models and seeing things come through. There was more questions than we could handle. There was a significant amount of great information presented. I wanted to thank each of these companies, GTreasury, Treasury 4, and Kyriba, for presenting. I want to thank everyone who has joined us. Thanks for joining this version of the Fintech Hot Seat Head-to-Head on cash forecasting. And I also wanted to invite you to join us for January's wait for it. January's head-to-head on artificial intelligence and machine learning use and plans. That's going to be held on January 23rd at 11 a.m. Eastern Standard Time. So whether you're in Europe or you're in the West Coast of the United States, great opportunities to hear that. Go ahead and register now. I see some questions in the chat box. You can see some of those comments in there now, registering for those. And yeah, thank you so much for presenting. Thank you so much for attending. Look forward to seeing you in January on the next head-to-head. We invite you to follow up with each of these vendors to ask additional questions as you're looking at forecasting. GTreasury, Treasury 4, and Kyriba are great solutions to consider. Thank you so much. We'll stand in line for just a few more moments, but have a great rest of your day.